There's something quietly strange about the way most people think about money. Not the big, dramatic mistakes, the bad business ideas, or the impulse purchases on credit, but the smaller, almost invisible logic they use every single day. I noticed it a few months ago, talking to a friend who was telling me with genuine pride that he'd switched to a cheaper phone plan and saved $30 a month. And in the same conversation, completely without irony, he mentioned that he'd been sitting on about $14,000 in a savings account for 3 years, waiting for the right moment to invest it. He had optimized the margins of his financial life with surgical precision while leaving the engine completely untouched. My name is Daniel, and what I want to talk about today isn't really a list of investments. It's the thinking that happens, or more often doesn't happen, before anyone touches a brokerage account. Because I genuinely believe most people aren't failing at investing due to a lack of information. They're failing because they've developed a very specific relationship with financial inaction that feels responsible, but quietly costs them everything. And 2026, with everything unusual going on in markets right now, is actually the perfect backdrop to unpack all of this. Let's start with something that doesn't get talked about enough. Most people treat their financial life like a renovation project they haven't started yet. There's always a reason the timing isn't quite right. The market feels overheated, there might be a recession coming, they want to pay off this one thing first, then they'll get serious. And so the months pass, and then the years, and the renovation never starts because the conditions for starting never feel quite clean enough. What's interesting is that this pattern doesn't actually come from laziness. It usually comes from a kind of perfectionism, a deep discomfort with making an imperfect decision in an imperfect environment. The problem is that investing has no perfect environment. It never did. Every generation that built wealth through markets did it during a period that looked from inside it genuinely uncertain. Here's the version of that I find most unsettling when I sit with it. If you have money sitting idle right now, say $20,000 in a regular checking or savings account, you are already making an active financial decision. You're just not framing it that way. Inflation in early 2026 is running around 3.5% to 4%. Most standard savings accounts are paying somewhere between 1/4 and 0.5%. That gap is not neutral. That's roughly $3,000 to $4,000 a year quietly leaving your purchasing power through a door you didn't notice was open. The renovation you've been postponing has a daily cost, whether you start it or not. That reframe is, I think, the most important mental shift anyone can make before touching a single investment account. So, if I were starting completely from scratch right now, the first thing I would do is resist the urge to immediately ask, what should I buy? Because that question actually comes third or fourth in the right sequence. The first question is, where am I leaking money to debt that costs more than any investment could realistically earn? Credit card interest rates in the US right now hover between 20 and 24% for most people. And this is where I want to offer a slightly uncomfortable reframe. Paying down a credit card charging 22% is not a sacrifice you make before you start investing. It is the investment, the highest returning one available to almost anyone reading personal finance content in 2026. There is no index fund, no managed account, no piece of real estate that reliably guarantees you a 22% annual return. That balance is a rival portfolio working against you, and it deserves to be treated with the same urgency as any high-conviction asset. Once high-interest debt is gone, and I'd use roughly 7% as my threshold, the next move that most people skip entirely is building a small but deliberate cash buffer before anything goes into the market. Not months and months of savings, just enough to cover one genuine emergency without having to touch an investment account. The reason this matters isn't psychological comfort, though that's real too. It's mechanical. Markets go down, sometimes significantly, and if the only money you have is in that account, a job loss or a medical bill forces you to sell at exactly the moment you should be holding or, ideally, buying more. The cash buffer isn't the opposite of investing, it's the infrastructure that makes long-term investing survivable. Now, here's where I think a lot of people who are otherwise doing everything right still leave significant money behind. Most U.S. employers who offer a 401k also offer some form of contribution matching. It varies by company, but a common structure is something like a full dollar match on the first 3 or 4% of your salary that you contribute. If your employer does this and you're not contributing at least up to that match threshold, you are declining a portion of your compensation every single payday. There's no softer way to put that. It's not a missed opportunity in the abstract sense. It's money your employer set aside for you that you didn't collect. Getting that match should happen before anything else in the investment sequence, full stop. After that, the account I'd prioritize before anything else is a Roth IRA, and I want to explain why in a way that goes slightly beyond the standard tax-free growth explanation. The deeper reason the Roth is so powerful for most people starting out is that it bets on your future financial success rather than punishing you for it. You pay taxes on the money you put in now, while your income is presumably lower than it will be in your peak earning years, and then every dollar of growth, every compounding return for decades comes out in retirement completely tax-free. You're essentially locking in your cheapest tax rate on the seed, then claiming the entire harvest tax-free. In 2026, you can contribute up to $7,500 annually as a single filer under the income threshold. That's not nothing. For a lot of people, it's the most efficient container they'll ever have access to. And if you have access to a high-deductible health insurance plan, there's a third account worth knowing about that most people treat as just a medical spending tool, when it's actually closer to a bonus retirement account. The Health Savings Account, or HSA, lets you put money before taxes, invest it, watch it grow without being taxed, and eventually withdraw it tax-free for medical expenses. After 65, you can withdraw it for anything at all, same as a traditional retirement account. The strategy some people use, and it's worth at least knowing about, is to pay current medical expenses out of pocket, keep the receipts, and let the HSA compound for decades. The IRS essentially never gets a clean shot at that money if you manage it deliberately. It's the quietest tax advantage most people have never activated. If you're still with me and thinking about what goes inside these accounts, I want to say something that might disappoint you a little. The actual investment choice for most people most of the time is almost boring in its simplicity. A total U.S. market index fund paired with some international exposure covers the overwhelming majority of what you need. Something like 60 to 65% U.S., 30 to 35% international stocks, and a small bond allocation, depending on how your nervous system handles volatility. That's it. That's the portfolio that beats most active fund managers over any 15 to 20-year window, not because it's clever, but because it's comprehensive and cheap. The average actively managed fund charges around 1% annually. Index funds covering the same ground charge somewhere between 0 and 0.03%. On a $200,000 portfolio held for 20 years, that difference quietly accumulates to a number that would genuinely surprise you if you did the math. If you want to subscribe for more content like this, there's a button somewhere on your screen. I genuinely love to keep this conversation going because this is the kind of thinking I find more valuable than any market prediction. The thing I want to leave you with isn't a ticker symbol or an account minimum. It's something that took me longer than it should have to really believe. The most destructive financial habit most people have isn't overspending. It's the chronic deferral of the decision to start. And deferral has a particularly nasty quality. It masquerades as caution. It feels like the adult thing to do. Wait until you understand it better. Wait until the market makes more sense. Wait until life feels a little more stable. But every month of waiting at 25 is different from every month of waiting at 45 in a way that no amount of financial discipline later in life can fully repair. Because the compounding that happens in the early years isn't just about the money growing. It's about the habit of moving money from income to investment becoming as automatic and unconsidered as paying rent. People who've built wealth through markets almost universally describe the investing as something they stopped noticing at some point. It became infrastructure.
The people who struggle describe it as a decision they keep meaning to make. So if you're at the beginning of this, or even somewhere in the middle wondering if you've started too late, the actual answer to what you should do in 2026 is simpler and less glamorous than any market analysis can make it seem. Deal with the debt that's working against you, build the smallest viable cash cushion, collect your employer match, open a Roth IRA, put something boring and diversified inside it, automate the transfer, then go live your life and let the calendar do the heavy lifting. The market will do something alarming at some point. It always does. The only investors who've ever regretted staying the course are fictional. If this gave you a slightly different way of thinking about where you are financially right now, a subscribe would genuinely mean a lot. It's how I know this kind of content is worth making. And I'd actually love to hear from you in the comments. What's the one thing that's been making it hard for you to start or stay consistent with investing?